What should you do about that home you were thinking of buying? Through the end of February 2022, existing single-family home sale prices rose nationally by about 20% in just 12 months, and about 3% in just 2 months. This is far above the 10-year increase of about 8% per year. But now, the Federal Reserve is warning that to get high and stubborn inflation under control, it will be raising interest rates steadily this year and next, maybe by another 2% this year alone. How might this affect the prices of homes, either the one you own or the one you're considering buying? Will demand weaken so much that home prices actually decline? Or are other forces still powerful enough that home prices will continue higher? And if you're considering a purchase, should you get moving or back off and wait a bit? Stay tuned as we discuss all this and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani. Here we've got the team back again, Adrian Nicholson and Erik Olson with us. How are you guys doing?
Doing good.
Yeah, fantastic. Man, had some really interesting conversations this week with some business owners who are doing things abroad that on social impact businesses that just got me so excited. So maybe I'll share some of those stories later. But yeah, so generally speaking, that has led things to be a great week. How about you, Roshan?
Oh, everything's going well. It's my my oldest 10-year-old birthday was on Monday. So he wanted to go to an Italian restaurant, so we took him there for dinner. And overall, a good week. Everything's going well.
Wow, that sounds great. What did he order?
It was lasagna, but it was like it had a fancy name. I don't remember whether it was like X triple meat, triple cheese, something like that with the name. But yeah, lasagna.
Fantastic. Good. Start him young.
Yep. It's one of his favorites. So yeah, everything's going great. Adrian, how's your wedding planning coming? You've got you're at about 6 months, almost exactly 6 months today.
Yeah, it's very exciting. We took a little bit of a break because it was my fiance's birthday over the weekend, so that was fun. We went out to a nice place for brunch and just kind of enjoyed the day in DC. So that was nice, and everything's been pretty much the same on my end since last time we recorded. So everything's been good. Wedding planning slowed down a little bit, but it'll pick up a little bit more come the summertime. So I'm enjoying just some R&R time over the weekend. It's not so much hustle and bustle as it used to be, where we are just tracking down vendors and just trying to book everything up. So everything's been solid on my end. Just happy to be here on another episode of the Retirement Lifestyle Show. I'm ready to get into today's episode. And Erik, I'm holding you to what you talked about in the beginning. I really want to hear about these businesses and what they're impacting and more about that. So I'm looking forward to this.
Fantastic. Well, I'd love to share some of that with you.
That sounds good. Let's jump into today's topic, and then we'll definitely touch on that at the end. We have a great one today. We're talking about how rising rates impact the typical American, and we are going to talk about the housing and the mortgage markets as well. I think this is very valuable because it's stuff you see every day or you see headlines about every day. It's almost disjointed. You'll see headlines about rising rates, what the Fed's doing. Then you'll walk in and live your daily life, and you'll see how things kind of impact you. I think will help bridge the gap of those two things, what you experience in real life versus what you read about, as far as how it impacts the typical consumer, how it impacts the overall economy. So I'm looking forward to getting into this topic today. I think the place we've got to start is just with the Fed, what they're doing with raising rates, and then we'll focus a little bit on the consumer, and then go a little bit deeper into housing. So, gentlemen, do either of you want to start us off with talking about the Fed and monetary policy, why they're raising rates, etc.?
I can, but Adrian, you have some comments about that?
Yeah, I could just start us off. One of the things that while I was researching about this area with the Fed and how it correlates with interest rate. You could take this back to 2020, the start of the pandemic, where the Fed was injecting a lot of stimulus in the economy and putting a lot more money out there. And there's just a lot of takes: were they doing it for too long? Do they do it too much? Now there's the question of, is this a correlation with how inflation has risen, and is this also what's happening where they're having to increase interest rates to kind of balance out everything that's going on? So those were kind of one of the starting points with this interest rate conversation, just the amount of money that's in the system right now and how monetary policy is going to react to the state of the economy right now.
Yeah, I think, first of all, we've talked in the past about the role that the Fed sees for interest rate policy in relation to evident inflation. And as we've talked about before, they see inflation emerging, so their intent in large part is to put a damper on that, and the best tool that they have for that is interest rate increases. I think it's evident that the narrative has been unfolding, and even in my own case, I don't know that it's merely narrative. I would say it's an understanding of what's actually taking place here. So early on, when we had an inflation episode, of course I was concerned about it, but I was pretty convinced that it was indeed transitory, and that it would be probably by the end of 2023 that we would be back down, not to the ridiculously low inflation levels, 1.8 or whatever it was that we'd had for a sustained period of time in there, but that we at least would be probably pushing back down into the 3% area, something like that, 3.5 maybe. I'm not so sure anymore. And the reason I'm not so sure anymore is that when you start measuring inflation in a variety of ways, you start seeing that the headline CPI number or the core CPI number only are addressing one part of the problem. I don't know if we discussed this in a recent episode, but I know I've had this conversation at least with some of my clients, that if you were to go back and use the CPI figures or the methodology for calculating the consumer price index in its original form, let's say 50 years ago, and you use those same constituent parts and weights today, what you would do is you'd say that inflation on the trailing 12 months wasn't 8.5, it was 17.1. So in this sense, if you start saying, wow, that is a much more expansive inflation rate than I'd probably been fully acknowledging. Now I think probably at the same time that what's taking place in the Fed is that they're recognizing the same thing. And as a result, they've decided they're going to get significantly more aggressive in response to that with interest rate increases.
Well, also, especially since interest rates really have been very low, and now people are seeing them starting to rise. So this is also something people are really looking at, where this is just a new change that it wasn't a couple of years ago, like 10 years ago, 20 years ago, but now people are experiencing these times of increased rates where the average individual were used to this low interest rate environment.
Yeah, and so Eric, what you had said, I would almost, because I don't have the information, I'd want to find out, is that same basket of goods relevant today from 50 years? Like what comprises that 17% number? But just getting us back to what we talked about, you mentioned this, and I think it's important that the Fed's managing monetary policy, and they're typically their strongest tool is the impact of interest rates. What they're doing is they're adjusting the Fed funds rates. We've talked about this on previous episodes. That's the rate banks lend money to overnight. And what happens is that causes, that flows through. So all the way from what banks lend, Fed fund rates goes up, what banks lend money to each other goes up, and then every loan almost across the board then increases, whether it's with businesses, the amount of money if they're borrowing money, their rates go up, and the consumers, whether it's mortgages or credit cards, auto loans, all those go up. So when they adjust this rate, it causes an increase. What they're trying to do is cool off the economy to manage inflation, right? As both of you said. So just I've used the example before of a car loan. Today we're talking a little bit more in depth about mortgages, so we'll do the same number here. If you were buying a $300,000 property and rates were at 3.5%, your monthly payment would be $1,340, and your total lifetime cost. So you paid $300,000 for the house. You're going to pay $485,000 when the loan, if you pay it the full 30 years, $185,000 of that is interest. But the key number here is that monthly cost of $1,340, because most people look at what they pay on a monthly basis. If rates are up just 1%, now this was an example done prior to rates going up even higher than that, but in a 1% increase causes a $300,000 mortgage, the monthly payment goes to $1,520. So you went from $1,340 to $1,520. It's $180. May not sound like that much, but it's 13.5% increase on a monthly payment. That number I gave earlier of total interest of $185,000 at 4.5%, it's $247,000. So to me, when we look at the Fed raising rates, this is an example with mortgages and housing specifically, but it then comes down to the next step of, okay, they're spending $180 a month more on the mortgage than they would have just really 2 or 3 months earlier if they bought the house. What are you not spending on now, right? Where that 180 was going somewhere else, where is it going to now? The second big question is then, okay, well, what if you can't afford that additional 180 per month? So you're no longer buying a $300,000 property anymore. You're now trading down to a smaller property or being completely priced out of the market. A lot of information there. I'm going to break that down a little bit more basic. Fed's raising rates. As they raise rates, if people stop buying buying properties, you've now lowered your demand on the property, and that will help slow down inflation. We talked a lot about a year and a half ago about people overbidding for housing. So a house would go on the market using the same number for $300,000. It eventually would settle out at $320,000, $350,000. Actually, Erik, you shared your story about that you sold and purchased in that environment where people were outbidding each other, correct?
Right.
Have you I know you haven't moved in the last couple months or anything, but have you seen through your clients or anecdotally a change? I know I have. I have heard a lot fewer stories of things getting overbid or going up. Now, I am hearing people say, well, pricing has gone up so much, but I haven't heard at all about people losing bidding wars as I've heard previously.
I have not, which doesn't mean that it's not happening in pockets, but among at least those of my clients where we've been having these conversations, the answer is no.
Yeah, I same experience for me. I'm not really seeing that there. When we go look at this and look at the Fed impact, and we'll go deeper into housing momentarily, are you seeing any other areas, or do you find any other good examples just to share with everybody as far as the interest rates and things going up? I've got a couple.
You mean in non-housing sectors of the economy where interest rates are having an impact?
Yes.
Well, so I'm aware, of course, that the next largest big ticket item that people oftentimes will finance is going to be the education of their kids. And right after that might be a vehicle. So, but at this point, my understanding at least is that the student loan interest rates are not sort of quite as fluid, and so I think in some cases those are set by policy. So, but on the auto side, I think what I've just understood there is that the key dynamic that's occurring there isn't so much related necessarily to interest rates, but it's to supply. And so people are paying sticker or more than sticker to get the vehicle that they want.
Yeah, I remember a year ago seeing prices be literally 10% or higher over sticker. I'm starting, and dealers were charging, uh, I forget,
Some
they
cleverly
created a
named
name
fee.
for it. They created a name for it, but it was an additional charge. So let's say the sticker price was 30,000.
Mm-hmm.
They'd say, oh, and then we add on our dealer charge, and they had a cool name for it. I can't remember what it was, and it's another 3,000, so it's 33. I've seen through a few clients that has come down.
Mm-hmm.
Now, comparing the mortgage rates to the market overall, or to other areas. You mentioned auto loans, so I'll start there and come back to mortgages. But the average auto loan for a 5-year loan, 60-month loan, was 3.86 at the beginning of the year, and it's 4.21 now. Right. So it's actually had a minor impact. Credit cards have had a similarly
Interesting.
minor impact with the average increase in rates. I'm trying to pull up that, see if I can find that number. I'll share it with you as soon as I find it. But you've seen mortgages start out at the beginning of the year right around 3, and now you're seeing mortgages over 5%, which is the highest since about 2011, I believe. So you've seen the bigger impact on mortgage, and if you think about mortgages, if you think about that, it'll make a lot of sense, right? Because a mortgage loan is a 30-year loan. So if you're lending money to somebody for 30 years, you're not looking at just what's going on today. You're trying to project forward to make sure you get a fair rate. Whereas with an auto loan, it's not 30 years, it's 5. So you're not locked in as long if you're the lender. And then going even further, credit cards, I believe many of them can just raise their rate, the next month. And I did find that number on January 5th, the average credit card APR was 16.3%, which is really, it's a high rate, especially when you look at what else is out there. But you fast forward to April, and the average rate only went up to 16.4%, right? For one, that 16% is a lot higher than other loans and the Fed funds rates we've talked about and so on. So the credit card companies have already charged a little bit more. But as I said earlier, they can adjust their rate and raise it when the typical borrower for a mortgage is getting a locked-in 30-year rate. So you're not seeing the impact yet on the credit card. But going back to what I said earlier when I used the $300,000 house example, if someone was sort of capping out their affordability level for that house, and all of a sudden now they've got to pay $180 more a month, maybe they're not able to pay off their credit card. So they weren't paying that 16+% interest, and now they are, right? So they've either got to cut back on spending to try to get that credit card paid off in future months, or earn more money. They've got to find a way to find another balance there. That cutback in spending could impact a lesser card, could impact less spending going out, and so on. And if you play that out, that's what people are worried about with the Fed and recession, right? If people are spending less money out there, there's less growth in the economy, and you have the recession risk, which I've seen most sources are putting that in higher chance of about close to about 40% chance right now. We've discussed this at length. I wish I remembered the episode number where Eric, you had said, and I don't disagree with you, that a mild recession isn't that bad. It's a deep recession that would be very concerning,
right?
Especially coming off of this huge stimulus the government's put in the economy the last couple of years. So, gentlemen, anything to add on just? Actually, I have one more point, then I'll ask you if you have anything to add just on thinking about Fed funds rate. Another thing I just found is a really interesting. This is not the individual consumer, but Home Depot issued bonds with 10-year bonds. They issued them 6 months ago, and the interest rate they were able to issue them for was 1.875. Now the interest rate, which they just issued last month, at 3.25%. So once again, that's not consumer, that's business. But at the end of the day, who's going to pay for that higher interest rate? Theoretically, it'd be higher prices when you walk into Home Depot, which is now another thing the consumer has less money to spend, right? You're paying more on your mortgage. Hopefully, you didn't have a credit card balance, so you're not paying a higher interest and you don't have a credit card balance. But then you go to Home Depot, you spend a little bit more money, so now you've got less money to spend in other places.
Yeah, I mean, all really good points. And the question that probably comes up, or the thing people are probably just considering, is just timing and patience when it comes to these rates right now, especially when it comes to a house. People right now may be questioning, should I just be patient? Should I wait? Or should I just pull the trigger on the home now? And I guess that's where the planning aspect of it becomes really important, just making this decision, especially I know it's relative, but this high rate environment right now, people are just considering what would be the best move. And it can just go from housing or something as small as just credit cards as well, where you're paying a really high rate right now. Would it be better if you just pay off the credit card or wait, or just, again, plan out what would be the best course of action? I think is just really important right now, again, where it is a difference of a couple $100 and even some cases $1,000. So it's a big decision. That's why we're just having this conversation today, where this increase in interest rate really has an effect across the whole board, where you really have to just plan this out and just really see, is it a good time to take action right now, or should you be patient? It really will can make a long-term impact.
So let's talk about the housing price dynamics in response to some of this. We talked about there's multiple factors that can influence housing prices, and interest rates are one of those. So let's assume for the moment there was nothing else except interest rates that drove decisions about whether or not to purchase a home, or at least said maybe in a slightly different formulation with respect to the decision about how much home you would care to buy. So let me take an example of a family, let's say, that has $150,000 a year gross income. They have no credit card debt or student loan debt. All they're thinking about is what's affordable for them on, let's say, a $3,500 a month payment. We're not talking right now about property taxes. We're just leaving aside that for the second, and we're just focused on the question of the $3,500 a month payment for principal and interest. By the way, fortunately, where I live, it's probably not necessary that you use some of the purchase price figures that I'm citing right now, or will cite in just a moment, but maybe where you guys are in Northern Virginia, and where a lot of our listeners are in other parts of the country that are more expensive, these numbers are fully legit. So you've got $100,000 of cash, you're making $150 saved up and ready to go with a down payment. You've got $150,000 income, and you're looking to target a $3,500 a month payment on principal and interest alone. Here we go. When interest rates for that 30-year fixed mortgage were 3%, the home affordability at that payment level would be $930,000 of home. You put $100,000 down, you're borrowing $830,000, you're financing that at 3% for 30 years, $930,000. If you raise that interest rate to 5%, then the equation changes. Still have $100,000 to put down, but that $3,500 payment now at 5% will only cover another $650 of borrowed money, not the $830 in the previous example. So you just saw that price, the affordability there drop by $180,000, or roughly 20% in that example. If you push those rates a bit higher, and gentlemen, I've paid these rates at earlier stages of my life, at the 7% level, if you're paying 7% on this mortgage, still $100 to put down, 30-year fixed, you got to cap it at $3,500 a month. Now your mortgage the home affordability drops even further. And in this particular case, you could afford to swing a home that's $625,000, or said differently, 100 down, borrowing 525. So in this example, that if interest rates were the only source of influence on home prices, then we can see that what the Fed is doing here, depending on how far they need to press to get these inflation rates under control, could have a significant influence on people's willingness to pay. So, gentlemen, with that as a backdrop, why then should our listeners not be concerned that maybe the homes that they're currently owning might now be suddenly plunging in value in response to these interest rate increases?
It's a question of just the impact on demand. If people have to pay more, it's going to impact demand in a negative way, where if rates are very favorable, then that will increase demand.
I agree with that. But I would say if rates were the only influence, then that would be a formula for a substantial repricing of residential homes against current owners. So, but why or why not should our listeners be concerned about the possibility that there would be a substantial decline in the value of their existing homes, in the value of them in response to these interest rate increases?
I mean, my answer to that is because since really 2007 or 8 roughly, you've had less housing starts, so there's currently a supply imbalance where there aren't enough houses as it is. So you're the key phrase you said if mortgages were the only factor. And in actuality, right, they aren't. There are other factors. One other thing I want to mention, though, is that I found not surprising. Actually, Adrian, I'm gonna pick on you because of your age on this question. Adrian, do you know have you seen what the historical average mortgage rate is in the United States? I wish I could give you a time frame. The quote I saw, it just says, the historical average was, and I couldn't find the source. Well, the quote was given by First American's chief economist, Mark Fleming. But Adrian, do you know what the historical average mortgage rate is in the United States? Let's just say goes back 100 years. If
it goes back that far, where I know rates used to be a lot higher, I'm just going to say 7%.
And Eric, just asking you, do you know the answer to this one?
I don't know the answer to that.
Guess. Throw a number out. Historical
I'll
average.
say 7. I think that's probably about right.
You both were incredibly close. It's actually 8, right? And if you think about that in context for a moment, and granted, we've had different economies, different things going on with the country, industrial revolution, et cetera. But people paying 2.5 on a 30-year mortgage is just ridiculously low with what was going on before. And with that 8% number, people looking at it at about 5.5% right now is doesn't seem that high. I actually remember I've never paid 8 or more. I never bought a property in the mid 80s when you had double digits. I have clients have given me multiple stories about paying like around 20% for a mortgage back then during the Volcker
highest I saw in my
era.
research was around 16%, but 20%, that's just incredible.
Yeah, and I don't know if it quite hit up there, was around there. I've definitely heard people reference 18s before. But my personal experience going back, about 20 years was 6%. So 5.5 still seems really high because 6 seemed really high back then.
Yeah.
Right. But it isn't that high. It looks particularly high when you compare it to just what people got a year and a half, 2 years ago. Or forget year and a half, 2 years ago. You're getting low 3s just in December.
Right.
So 4 months ago, you're paying about 40% less.
One source I saw this morning said that right now the median rate across the country on a 30-year fixed is 5.28, and it is amazing how much just since January that has risen. I think it was in the 3s in January, and now it's in the low 5s. Having said that, by the way, just as a quick aside, I'm not here to sell any sort of price comparison tool or anything like that, but with just a little bit of Googling, you can find some mortgage comparison tools. And if you are in the market and you're thinking about doing this, you can find rates that are maybe 3/4 of a point lower than what I just cited at any given term. So 30 years, or maybe it's 0.6% lower at a 15-year term if you'll do some careful shopping around. So don't feel like the rates that we're citing right now are necessarily the ones that you would get. You can look around and find something else. But coming back to this larger story about housing, we said if interest rates were the only influence, then that would have an influence on prices, substantially pushing the price pressure downward. But as you explained, there are other considerations, one of which, Roshan, you identified, which is a supply constraint in the aftermath of the great housing trauma of 2006, 7, 8, and so forth. There was a dramatic reduction in home building. And although there's been some revival of that now with the difficulty that builders are finding and obtaining oftentimes the materials that they would use to construct these homes, that's been another form of pressure as well. But what are some other variables that people should understand are influencing home prices and shouldn't lead them necessarily to conclude that these rising interest rates will almost necessarily mean their home values will drop?
Well, I don't think this will tie into what you're thinking about location. That's always just a factor. It's not going to be the same across the board. Like you said,
so true.
It's going to be in certain pockets. You may see prices go down in one area, but up in another area. So that's definitely an impact.
And just to build on that point, if U-Haul issues a heat map of the United States periodically, and they show which states are having the most significant imbalance in trucks coming in and trucks going out in terms of full or empty. My practice is in northern Illinois. That state is number 49 for inflows. Only California has a bigger outflow problem. And it's probably no big surprise that some of the top names in terms of inflows as opposed to outflows are Texas, Florida. Let's see. I believe it is Tennessee. I'm drawing a blank on a couple others. Oh, Idaho. These are some of the big states of big inflows. Maine, Vermont, and New Hampshire also surprised me that they were pretty high ranking up there. So you're precisely right, Adrian, that if someone sort of gloms on to a particular area, boy, oh boy, the inflows of new people seeking homes there. I've heard, for example, in certain parts of Idaho, it's just crazy how much there's an imbalance in housing supply and what that's done to housing prices over the last couple of years.
And going back to the supply conversation, all of these supply chain issues aren't helping, right? For we've got a multi-year supply shortage, right? Going back to roughly '08, because there just weren't enough homes built. You've got more buyers out there, and now if home builders even wanted to, they couldn't build enough homes to catch up quickly because they can't get the materials.
I was talking with the builder of my home, and he was telling me his order backlog, given the constraints on the supply materials and on the labor, he presently has a 2-year backlog in being able to accept a commission to build a custom home. Wow. Amazing to me. So I wanted to identify a couple of these variables, and you've touched on now the location issue as well as the supply issue. Another is the demographic issue. So we have seen, especially because of that constrained supply now for so many years, a lot of millennial household formation is now at the stage where a lot of millennial households are looking for homes. And that the wave, just as was true of the baby boomers before them, the demographic influence of the millennials coming through the pipeline of the economy at this stage puts a lot of pressure on housing. So I think even at that level, while it is unquestionably true that maybe because of the very dynamics that you outlined a little bit earlier in our conversation here, Roshan, about how the marginal buyer is looking at a home priced at a certain level and now is saying, wow, that payment might be another $180 a month. That buyer might step out of the game. But what does that do? That means that now instead of 20 people lining up to bid for a home, it's maybe 10 or 15. It takes some of the pressure off, but it's not like the demand has gone away. And so I think on that level, that's a very powerful driver. Still another is household balance sheets. One of the influences of the massive redistribution under the COVID policy to essentially push all sorts of stimulus money into the households and as well with many people restraining spending on some of the more discretionary expenditures they might once have made, particularly travel or dining out or some of these other things. It has really shored up many households' balance sheets. And as a result, now personal savings at levels, household savings levels are at levels now where that down payment can be larger than it might have been before. And as a result, that less needs to be borrowed. So even if the interest rate is higher on the amount that is borrowed, it's not necessarily the case that it's now been impossibly priced at these current levels. So demographics, household balance sheets, location, the shortage of supply. I think when you put all of this together on a composite basis, I think what you'll find is that housing prices, while they may not rise at the same pace they did in 2021, which depending on the source you're consulting was somewhere between 15 and 20%. That also again varies by location. But I wouldn't be surprised if you see somewhere in the 5 to 8% area. I wouldn't be surprised by that at all.
Yeah, the Fed raising rates, as you shared the numbers. I did from more of a payment. You did more from a purchase price perspective.
Mm-hmm.
Can slow things down, but as you had said, and I agree, the other factors are sort of pushing prices up. And if they reach even if they reach a historical balance level, which is housing rates, prices raising at the rate of inflation, and I'm not going to use current numbers just because I do think they're going to, the current inflation rate data we're getting is higher than what I expect it to be 6 months or a year from now. But if you use historical inflation rates of about 4% increases, if it were to slow down to that from, as you said, about 20%, I think was the number for February. If they slow down to a 4 from a 20, that will look like a huge drop, right? But prices still went up. So from a buyer perspective, and Eric, you said you're not selling software, you're also not selling homes.
Right.
But and without putting words in your mouth, would you, if you had someone that said, hey, should I wait to buy or should I buy now with all those factors considered, assuming affordability is there, if they're doing purely what I'll call a speculative housing move, should I buy now or will I get a better deal if I wait a year? Would it be fair to say your opinion would be buy now versus wait a year?
I probably would be going that direction. And here's one other reason why. And that is that when we've talked about some of these previous periods of really elevated, at least compared to what we've been accustomed to more recently, elevated borrowing rates for homes, inflation was in most cases lower than that borrowing rate. And said differently, the inflation impact was only absorbing a portion of that borrowing cost. So indeed then you had a real, as opposed to a nominal, that is or for those of our listeners who are saying, what does real mean? In this case, it means an inflation adjusted borrowing cost. It was still positive. It was still costing you money, even in real terms, even in inflation adjusted terms. Right now, if inflation is running at 7.5, 8.5, somewhere in there, even using some of the more restrained estimates of that spending, and you can borrow at 5-ish. That's actually now the real borrowing rate is negative, meaning said differently, inflation is subsidizing your interest rate. So on that basis, I would say you're in inflation adjusted terms, these are quite suppressed borrowing rates for homes. And so I don't know that that will stay that way indefinitely. If it gets to a point where interest rates rise to 7 and inflation comes down to, let's say, 5, now you're back into it's actually costing you money to borrow money, even after adjusting for inflation, whereas right now inflation is subsidizing you. So for that reason, I would say don't drop out of the market just because you've seen this rise in these rates.
I'm also curious too on both of your takes on adjustable rate mortgages now too, especially with rates increasing. I know that was one of a big area that people were talking about during the 2008 crisis. That was a big deal, adjustable rate mortgages. And now, since rates are increasing, where people are looking at just commonly fixed rates more than I'm assuming adjustable rate mortgages, are those coming back on the scene? Are those something that our listeners should maybe look into more, or just consider when they're looking into purchasing a home?
I mean, I'm an advocate of researching everything, right? So if you're a consumer and you're looking into it, I wouldn't, as a blanket statement, say yes or no. I'd say research all your options and then make a decision.
So do you know like a scenario where adjustable rate mortgages, or do you have a client that got one recently or in the past where it worked out really well compared if they went the fixed route?
Well, interest rate. So yes, but that story of a positive adjustable rate mortgage story, that goes back like 7 years, where I had a client do it, and I don't remember if it was quite 7 years ago. It was a while, and they got and I'm gonna not remember the exact details, but hypothetically speaking, let's say they got a 7-year mortgage. It was locked in for 7-year adjustment, so it was locked in for 7 years. Then it adjusted. Well, they sold within that time period. So they were able to get a lower cost of borrowing. Now, if you look at more recent history, and I have, as I've said, I'm an advocate of researching everything. I have had multiple clients make property decisions and look at it, and we looked at all the options. But adjustable rates just really didn't make sense the last couple of years because your fixed rate was so low. I imagine that you'll probably see more of an opportunity there just because rates have gone up. But as of right now, putting this into context, these rates have gone from, roughly 3 to 5 in the last 4 months, right? So I haven't had many situations where I've had clients, narrowing it even further, it's only been 5% plus for a month or less. So I haven't personally had any situations myself or with clients where I've seen done a comparison with an adjustable rate, but and I keep hesitating because I think the conservative answer would be you get a fixed rate loan, you're not worried about what's going to happen, but I think you've got to go deeper into everyone's individual situation. Your typical buyer, in my experience, isn't thinking, "Hey, I'm only going to be here for 7 years." When they go into a property. So I think that makes them lean towards a 30-year, and that one example I gave, that was a refinance situation as well. So usually if people have been there for a few years and they're refinancing, they've seen how their life has changed, they can then say, okay, yeah, I don't think I'll be here in this many years. So I guess I'm not giving you a specific answer aside from saying do the research and look at your own situation when you make that determination. Erik, how about you? What would you say to Adrian's question?
Well, I would just comment, Adrian, when we saw the great bull market in bonds, which was a direct byproduct of the successive, consistent lowering of rates over time from the early 1980s, those of my friends who were using the ARMs were doing so, seeing that decision rewarded over and over and over again, because even after, let's say, the 5 or the 7 years had passed, they weren't getting jacked with giant increases. And if anything, they were able to reset those down to lower rates. So they started lower and then they continued lower. So I think it really, today in a rising interest rate environment, is the same question that Roshan just outlined, which is how long do you expect you'll probably be in that home? And if you can't say with confidence, yeah, I'm always having to relocate every 5 or 7 years, you probably want to think really closely about the longer term fixed rate. But if you are in a situation where you're gonna get, for reasons of the company you're part of, and they're constantly moving you around or something of that nature, then that 5 or 7 year ARM can make a lot of sense. I'm looking at one right now, for example, the APR on a 7 year, what's known as a 7/1 type of ARM, where you go 7 years with this particular rate locked in, and then you switch over every year thereafter. You can have that reset according to the formula that governs it. What you can have in this one, and granted, paying some points, but your rate can be under 4%. This is priced at a 30-year basis. Whereas if you went just flat out with a regular 30-year, you'd probably see that rate starting, even if you shopped hard and found the best rate out there, you might find that at this point maybe in the low 4s with some lenders, and again paying some points. So you'll maybe save at this point a quarter point or a little more maybe if you go that route, but it just really has to be circumstantial for that formula, I think, to work.
Yeah. So, and if it's not circumstantial, you're essentially doing rate speculation.
Mm-hmm.
And do you want to? What happened in '08 is people would use these adjustable rates, and the stuff you see about what crashed the economy and so on. People were using these adjustable rates to buy houses they couldn't afford, right? So then
Right.
when the rates adjusted, they had to fire sale these houses, and that happened all over the country to a bunch of buyers at the same time. That's what crashed things. So what I do think is a little different now is, in addition to the rate, currently, you've also got credit scores that you need to get the loan. And those credit scores were kind of thrown out the window in '08. I've mentioned
Right.
this multiple
No doc
times. My favorite
loans.
one being the ninja loans. But yeah, no documents for anything needed. That stuff's gone, right?
Stated income
And
loans, reverse amortization loans. It was crazy.
yeah, and with those things not being in the market anymore, I think that we aren't at risk of this major crash that happened in '08 if people take on adjustable rate mortgage. But I would once again caution, I would ask why and caution you against interest rate speculation, uh, because if it's circumstantial and you're going to sell the house, sounds like a great move. If you're just trying to make a bet that rates will go up or down, I'm sorry, down essentially, not up, or you wouldn't do the arm. But if you're trying to bet that rates are going to go down, you just need to make sure you're in a position to afford it if they don't. And I guess the way I would calculate that is say, okay, let's say you really are confident that that's going to happen and you really believe in it. Well, first, not only make sure you can afford a 30-year at the current rate, run the math to say, well, what if rates go up X amount? Can I still afford the loan then?
Mm-hmm.
So if you're going to speculate on interest rates, make sure you can afford to be on the wrong end of that speculation before you make that move.
Well, gentlemen, good discussion. Are there other things that you think are valuable for our listeners to understand on this subject?
There's one other thing I'll mention, not necessarily for understanding, just for you to think about going beyond this, is Eric, and you weren't on this one episode where Adrian and I talked a little bit about peak inflation.
Mm-hmm.
And yeah, I believe it was UBS that have called peak inflation, which would mean theoretically things will slow down and the Fed might not have to raise rates as much as they have to. Back in December, the expectation of the market was a 0.75 percentage point rate hike for the entire year.
Right.
The Fed's already raised it a quarter point, and the expectation right now, they've guided towards a half point increase in May.
Mm-hmm.
So the market's pricing in a 2.5% increase by the end of the year, and the question would be, looking at what UBS was saying is, well, is that potentially overstated? Could inflation slow, give the Fed giving the Fed an opportunity to slow down, which would then mean theoretically that mortgage rates have overshot and maybe they'll pull back, right? I'm not saying that that's my expectation at all. It'd be interesting to see. But if you're making these decisions or even just thinking about the economy long term, I think that's an argument that you've at least got to look into.
Yeah, good. Adrian, anything else that you'd like to offer?
I went over everything I wanted to cover. I think it was a great discussion. If we can transition to move on to what you mentioned in the beginning, Eric, I'd love to hear more about that, unless either you two have anything else to add for today's discussion on rates.
Now, Eric, let's go ahead for our listeners. I was going to say investors, for our listeners with stamina that have been here and stayed with us. A nice shift, and Eric, your thoughts on what you experienced and the business owners you met.
Yeah, well, I'm going to talk about one in particular, and he's a serial entrepreneur with businesses in different parts of the world. But his intent with these businesses is, yes, they are to be profitable. If they're not profitable, they can't be sustainable. They go out of business. So they are profitable, but it's also chiefly designed, in his case, to find ways to provide work for people who otherwise would be trafficked. And so he was talking about, in particular, one business which it's creating really high-end furniture for multi-million dollar yachts. And the strategy that they're using is to find seamstresses to hand stitch some of the leather for these I'll call them couches and chairs and other things of this kind in regions of the world where there would be, there's a high prevalence, the Golden Triangle, in particular of Southeast Asia, a high prevalence of sex trafficking. So I just thought, man, it is just, when I hear stories like that, finding a way to bring them into the value creation chain for, in this case, a niche market that not a lot of other people have given thought to, I thought, that's brilliant. And to be able to find a way to formulate the process and coordinate the movement of materials and so forth in such a way that they can have an extremely high quality product that is in demand, but also then transmits a significant share of that wealth to these women. I love those kinds of stories. And there were other stories he told as well, but that's an example of one of those several stories in the several businesses he's running.
Wow. And what countries are they building in?
So in terms of the end users are yacht makers here in the U.S., but in terms of the creation of this, it's in parts of that Golden Triangle region of Southeast Asia.
Wow.
Isn't that cool?
It is really cool. I when you say in the U.S., I've read so much with the sanctions about yachts by Russian oligarchs.
Right. Well, here in Holland, Michigan area, which if I drove 10 minutes, 12 minutes, I would be at one of the leading luxury yacht makers in the United States. They've got this giant facility, and so that's a natural customer for this sort of product.
Yeah, I mean, I got to believe anybody out there that owns a yacht would want to get their furniture from a business that not only provides high quality products, but impacts communities and individuals' lives in a positive way.
Well, Adrian, that's an interesting point. I don't know the extent to which the yacht makers make known to the buyers of their yachts what the source of these and the story behind them. I'd love it if they did. I mean, that would be fantastic. But it's just actually 2 weeks before, I think I mentioned, did I mention this? I was privileged to be part of a conversation with, I know it seems like a lot of times my stories gravitate around trafficking in particular, but this is somebody running a business in Nepal, which is in bringing Westerners in who are interested in adventure travel and then the revenues from that business are used to provide jobs for men and women, but in this case, the more vulnerable among them are the women, who otherwise might head out to other parts of the region in the sex trades. So I think here it is just it's a fantastic thing that these entrepreneurs have this sort of vision to create a viable income alternative for these women.
Yeah, and especially you said this one entrepreneur has multiple businesses. So
Mm-hmm.
the fact
Mm-hmm.
that he's able to do all this and be able to make these business profitable, it's very incredible that they're able to use their time to not only create such a nice business, but again, just to help out so many people. So we need more
Mm-hmm.
people
Mm-hmm.
like that in this world, that's for sure.
Mm-hmm. Yeah, absolutely. All right. Well, anything else, gentlemen?
A great episode for everyone that's listening. As I always say, please like, subscribe, give us 5 stars. Tell your friends and family. Check out the website, retirementlifestyleshow.com. It's got all our previous episodes. I know we didn't reference the numbers, but we definitely talked about a bunch of previous episodes today. And finally, as we've mentioned in the past, if you need help, we are here. We are here to help and support you. You can reach out to us through the website, through the show notes, and we'll be back next week with another great episode. This has been the Retirement Lifestyle Show. Thank you for listening.